Last time our analysis looked at Sturm, Ruger and Company, Inc., a more, let's say, traditional manufacturing setup. Today, though, we're jumping into something quite different. We're dissecting AIRO Group Holdings, Inc. They're an aerospace and defense company relatively new to the public markets, just IPO'd back in June 2025.
Yeah, AIRO is certainly an interesting one. They operate across 4 pretty high-stakes segments: drones, avionics, training, and also electric air mobility EVTO development is in there too. Just the sheer scope of what they're trying to do makes it, well, a really crucial, if maybe highly volatile topic for us to debate.
Right. And the core disagreement today, I think, boils down to this. Is AIRO fundamentally undervalued? You look at its balance sheet, the metrics seem strong. Revenue growth is explosive. Or does the current market price actually accurately reflect some pretty severe risks? Execution risk, governance risk, that kind of thing. My position leans heavily towards the valuation argument. I see this as a compelling, maybe even heavily discounted opportunity right now.
And I'm coming at it from, well, the other side. You absolutely can't ignore that massive growth momentum. I grant you that. But I think deep skepticism is really warranted here. I'd argue the current pricing is probably fair precisely because it accounts for those enormous execution risks, the still unproven path to actually making money, and some major, frankly, undeniable concerns around financial integrity and what insiders are doing.
Okay, well, let's start with why the market valuation looks kind of broken to me. We're looking at a price-to-book ratio, PB, of just 0.72. Now, that means the market is pricing this high-tech aerospace firm significantly below its tangible asset value per share. We're talking $18.15 price versus a book value of $25.15. That kind of steep discount, you usually see that for, like, failing old-school industrial companies, not firms experiencing hypergrowth in really critical defense sectors.
That PB ratio is genuinely intriguing. You're right. It definitely demands an explanation.
And beyond that sort of asset floor, the financial health seems pretty solid, especially for a growth company. They show almost no reliance on debt, right? The debt-to-equity ratio is tiny, only 0.03. Liquidity ratios, okay, they're a bit thin, but acceptable. Current ratio 1.19, quick ratio 1.03. But, and this is important, they recently completed an upsized public offering, $89.4 million, which clearly boosted their cash reserves significantly.
Okay, but that healthy cash position, it really only matters if the underlying business model itself is fundamentally solid, wouldn't you say? You've presented what looks like a strong foundation, sure, but I see some fundamental structural flaws, almost like, a chimney that's about to topple over, in their actual ability to turn that strength into shareholder returns.
Well, the operational momentum suggests they will. If you look at the Q2 2025 results, they delivered this massive revenue surge, 151% year over year, plus nearly 79% sales growth quarter over quarter. And they beat earnings expectations. So this performance, combined with getting included in the Russell 2000 and 3000 indexes, it really seems to validate their growing importance in the sector.
I'm not denying the sales growth numbers. They're big. But let's talk about the quality of that 151% growth for a second. AIMRO, well, it lacks established profitability metrics. The PE is negative, obviously. And crucially, we don't have any reported key margin data. No gross margin, no operating margin. Until we actually see those margins, that explosive growth, it's effectively blind growth, isn't it? We don't know if they're making money on those sales.
I understand that margin concern. I really do. But when you're looking at a 150% plus growth rate in a sector that's so heavy on development, like defense tech, aren't we maybe asking a bit too much, too soon, for standard GAAP profitability? I mean, isn't every hypergrowth tech story about prioritizing market share and development over those short-term earnings initially?
But that high expectation embedded in the stock is exactly the problem. You look at the analyst consensus average target price, it's sitting way up at $30.67. That implies, nearly 70% upside from where it is now? But that huge forecast, it's based entirely on them successfully executing extremely high-risk, very long-term projects. Things like the medium-lift cargo drone planned for 2027 and the whole eVTOL development. These are absolutely not guaranteed outcomes.
Okay, wait. Before we completely pivot to the qualitative risks, I assume you're going to bring up the insider transactions, which, frankly, I think are maybe being a little overblown.
We definitely have to talk about them. Look, despite that high overall insider ownership, 36.78%, which is significant, the net insider transaction figure is negative 8.62%. And specifically, you had the executive chairman, the CEO, and a major 10% owner all selling substantial amounts of shares in mid-September 2025. The timing, immediately after reporting strong earnings and raising capital, that sends a very, very poor signal to the market in my view.
But surely those short-term sales have to be balanced against that huge disconnect in the valuation we talked about. Why is the market giving AIRO such a deep discount on its hard assets, if the insiders are the only concern?
Well, I'm just not convinced by focusing so heavily on PB here, because press-to-book valuation, it's just less relevant for a high-growth company that's operating in these high-risk, future-facing segments like drones and eVTOL. Investors in this kind of company, they aren't really buying the current physical assets, right? They're betting on massive, currently unproven future cash flows that are tied up in intellectual property and execution. So the market isn't ignoring the assets. It's waiting for proof that the company can actually successfully commercialize those future ideas.
Yet that skepticism, shouldn't it be reflected more in profitability ratios, not necessarily punishing the price to book so heavily?
And I think it is reflected there too. The absence of reported gross or operating margins, that lack of clarity, combined with the fact there isn't even a reported price-to-sales ratio available, it indicates the market is basically holding its breath. They're questioning whether that really impressive 151% revenue surge actually translates into sustainable, positive cash flow, or if this revenue is just being generated at a loss simply to grab market share early on. And that's a compelling point you make about growth potential, but let's really dig into the operational reality here. Have you properly considered the execution risk baked into these ambitious timelines? Take the drones division. It's currently bringing in the most revenue, right? But it still faces this really critical hurdle: securing Blue UAS certification for their RQ-35 Hedron drone. Now, that certification, it's basically the U.S. Department of Defense's seal of approval for security and trustworthiness. It's absolutely mandatory if they want to fulfill that key defense demand. And furthermore, the core growth drivers that the whole bullish case seems to bank on, things like the middle-mile cargo drone, the eVTOL aircraft, these are scheduled for 2027 or even later. This introduces incredibly long regulatory timelines, commercialization challenges, testing phases, not to mention significant supply chain exposure. All of this delays any potential return on investment for years. So you're essentially buying very high risk today, hoping for a payoff way down the line. It's pure expectation.
AIRO seems to be aggressively tackling this exposure through strategic partnerships. Take the joint venture with Nord Drone Group, for example. The aim there seems to be deploying battlefield-tested technologies more quickly, which should help accelerate some timelines and reduce the burden of doing everything solo. And they're also collaborating with established players like Joby Aviation for their avionics segment, so they aren't entirely going it alone.
Partnerships are helpful, sure, but they don't magically erase those critical certification hurdles or the governance black cloud that we really need to discuss next.
But the institutional confidence seems pretty palpable, doesn't it? The fact that analysts have the stock targeted on average well over $30, that reflects some serious confidence in their ability to actually execute and capitalize on what are undeniably massive industry tailwinds in defense tech and autonomous mobility. The market, or at least the analysts covering it, seem to expect them to clear those hurdles eventually. Okay, let's tackle those qualitative risks head on then: the insider sales and the litigation. Now, while the recent sales by key figures, yes, the chairman and CEO selling shares, are certainly noteworthy, you have to remember the overall insider ownership remains really robust, over 36%. And executive selling, especially right after a major public offering like they had, can often be driven by, personal liquidity needs, maybe portfolio diversification. It doesn't necessarily signal a fundamental lack of faith in the company's long-term prospects.
My perspective is that insider selling
immediately after raising capital and putting out strong earnings, that sends a very specific message. It suggests that the executives might believe the stock is perhaps fully priced or maybe even overpriced at that moment, regardless of their overall high ownership stake. It's the timing that's really problematic for me.
But you have to consider the surrounding context, right? You've got the index inclusions, major contract completions like that naval special warfare training mission they highlighted, and the strong Q2 results we mentioned. Surely these fundamental positive drivers should outweigh what might just be short-term negative signals from some trading activity.
I think that volume of potentially positive news is severely, maybe even fatally undermined by the specific allegations that are detailed in that Delaware Chancery Court lawsuit. I mean, the sheer audacity of the claim that directors allegedly enriched themselves with $30 million in company shares and then pushed out the COO who was investigating it, that creates a massive unavoidable governance cloud. And this qualitative risk, the risk of financial instability, of self-dealing, it undermines all confidence in the reported quantitative metrics, no matter how low that PB ratio might be. It points to a potentially critical long-term risk for minority shareholders.
So to summarize my view, AIRO has, I think, established a compelling floor with its asset value, clearly reflected in that historically low price-to-book ratio. It is delivering genuinely explosive triple-digit revenue growth in absolutely essential defense and aerospace markets. The upside potential, which is highlighted by that high analyst consensus target, suggests this could be a massive discount on a potential future leader, if management successfully navigates what are admittedly complex commercialization and regulatory hurdles ahead.
And to summarize my perspective, AIRO seems caught in this difficult place, right, between really aggressive technological growth prospects on one hand and substantial structural risks on the other. Until the company can actually demonstrate consistent margin expansion and prove it can turn that surging revenue into sustainable profitability, and crucially, until it resolves these major concerns hanging over executive financial integrity and clarifies the long execution timeline for its biggest projects, while the stock just remains a speculative, high volatility play that's discounted, I believe, by necessary caution.